Folks, I think we need to have an honest discussion about something that very, very few people are discussing. And we're going to have this wonderful conversation with the one and only Anna Kelly. How you doing, Anna?
I'm doing great. Great to be here today.
I cannot imagine somebody better on this channel to have this conversation with. I'm going to hit you with something, and I just want you to react. And what if we have zero rate cuts in 2024? What do you think that means? Where do you think the pain goes? Why don't I just stop there again? No rate cuts 2024.
Sure. I wouldn't have thought that to even be a possibility until we had 2 months of inflation going up, according to the latest stats this week. And so, I think the probability is increasing that we might have zero cuts. Probably not significantly. I still think we'll have a couple, but not nearly as much and as soon as most people think. So, if we didn't have rate cuts, and the argument could be made and is being made by some that we shouldn't have rate cuts because inflation is clearly on the upswing over the last couple of months, and that is nowhere near the evidence that Powell has said he needs to see. Clear and convincing evidence that inflation is heading toward 2%. So there's some that actually argue that we shouldn't have rate cuts. So, for any of those that are going to tune it out and say this is a pie in the sky, we don't know. There's a lot that we don't know. So if it happened, I think the biggest pain would be the commercial real estate sector, which is already experiencing significant pain. Two, in commercial credit. And then three, because of the domino effects, all the banks holding those loans that need to be reset. So pushing us closer to a banking crisis where we have more small regional banks start to fail. So those are the things that I think would be the big ahas, the big problems that we would need to really think about if there were to be no rate cuts. And there are things that the Fed and Powell are already recognizing and realizing are at risk now, even if they do start to cut, because of just how much debt has to be refinanced this year and how many companies and real estate investors just cannot refinance these loans.
Yeah, I want to peel a lot of that, but I also want to go to the other side of the equation. Again, if we're just having a what if scenario, right? So what if no rate cuts? It also likely means not only is inflation staying at or above 3%. So it's not coming into 2. So inflation is still sticky. But it also, in my opinion, likely means the job market doesn't crumble, right? It does probably mean the unemployment stays at or below 4.2%. Wage growth is probably still in real terms and nominal terms still positive, right? Because again, I think we can both agree if the unemployment spiked to 5%, he's cutting rates. I mean, that's happening. So if he doesn't
Right.
cut, it probably also means the job market stays healthy. Is that fair?
It depends on what you mean, which is causing which. If the job market stays healthy and inflation stays up, Powell will not be urgent to cut rates.
Nope. Nope.
If though rates stay high, I would argue that that would lead to significant unemployment and recession much more quickly, which would then lead to Powell reacting and cutting rates. So, what the Fed does with rates will impact the job market. What happens with the job market could impact rates. But I would argue that the job market is already much healthier than what the headline numbers show. If you look at the job
Much
market,
unhealthier.
yes, I'm sorry, the job market is much unhealthier than what the
Unhealthy.
headline
Oh,
numbers show already. And so
agreed.
if you look at unemployment, even though we had 200,000 or so jobs created,
Mhm.
most of those jobs were part-time jobs, not full-time jobs. We haven't
Absolutely.
actually had a net positive full-time job creation in 2 years, Michael. It's 2 years. Most people, that's not the number that shows up in headlines. It's just how many jobs were created. Well, they weren't
Mhm.
full-time jobs, number one. Oftentimes it's been government jobs, number two, and we're starting to see layoffs. So even with a positive job creation print, unemployment ticked up to 3.9%. So we're
It
close,
did.
moving from that 3 to 4 number. But what happens is if rates stay higher for longer, more companies will have to refinance debt at higher rates. Consumers are already starting to get nervous. They're pulling back on spending. They're defaulting on auto loans. We've talked about this, the last couple of shows. They are going to, buy now, pay later. They're defaulting on credit cards. They're raising their credit card debt. So the consumer has been absolutely rocked. And that is going to cause employers who have held tight and not laid off yet to have to start saying, we're not making as much profit. I think you're going to have kind of this double dip profits recession, earnings recession. And as that happens, companies are going to start laying off. A lot of companies haven't had to lay off yet because they were able to kind of term out some of their debt. And because the consumer has continued to spend, even though they're doing it on debt. And that top 20% of income earners haven't been hit hard and are still spending. So you have kind of this bifurcated market. But as we start to see the consumer more and more stretched, if the Fed keeps rates higher for longer, all these companies that were able to kind of skate by without having to refinance debt or really lay off, they're going to go, okay, we're coming close. I have seen, read, listened to the stat that just like commercial real estate has about 20% of loans that have to refinance this year out of the $5 trillion of loans coming due, it's about 20% per year over the next 5 years. It's similar with corporate debt. All these corporations that we see going crazy in the stock market. Some have been able to get their loans just long enough that they're just hoping that the Fed cuts rates and they can refi. Some won't survive, and that's going to cause an uptick in unemployment. So I think the longer inflation is high enough that Powell doesn't cut rates, the higher the risk you have that employment goes up, not down, that companies start more layoffs and, all of these things kind of being a domino effect.
No, I agree with all of that. Again, this is just a what if scenario, not what either of us see coming. But again, I think there's certainly, I mean, again, anytime you put a time frame on it, we're talking a calendar year, you can easily see the pain being delayed long enough where, hey, it all shows up in Q1 of 25. And that might be the case. Again, we're seeing a lot of extended pretend. We're seeing a lot of people take debt and just add a year to the term, right? Maybe they did a 2 with a 1 option. There's a lot of that going on. The other thing we're seeing with employers is the reluctancy to lay off, to your point. And that's because a lot of them had a hard time hiring. As an executive at companies who's had to unfortunately go through a nasty recession and lay people off, I can tell you we fought it until it was like it's a solvency problem, right? If we don't whack 12% or 14%, whatever the number was, we're not going to make payroll in 8 weeks or whatever it was.
Right.
So the question is, when does that happen? Right? Is it Q2? Is it Q3? I don't know. I mean, I don't know if you
really
saw
hard, just like you said, we've gotten timing wrong. And the reality is that because of the amount of liquidity that was in the system, the amount of money supply that was in the system, both in households and small businesses and corporations, these lag effects of, the significant hike in interest rates and in inflation have had is that everything is taking longer to kind of manifest than everybody expected. And so because of that, everyone's like, oh, well, you got the recession call wrong, right? We were calling for a recession close to 2 years ago. So was Jamie Dimon, the head of one of the largest banks in the world. Many economists thought that we could not handle these higher rates for very long and that we would have a very quick recession, and that these companies and banks and commercial real estate owners could not survive very long. Well, the lag effects of all of that easy money that was in the system for so long, and quite frankly, a lot of people sold at the top, and so they have a lot of cash sitting on the sidelines. That has allowed the economy to keep chugging along despite what everybody thought for longer than they thought. But here's what I do truly believe, based on studying history, that any time that you've had a recession, it looks like the economy is absolutely booming about 6 months to a year before.
Agreed.
It's the way things work, because
Hmm.
you get this height, people get cash, they sell, they increase their wealth effect, and then things kind of chug along, and then they start to show signs of cracking, and then it's kind of, oh, suddenly. So
Yeah.
everyone, in 2000, everybody in 2006 and early 2007, everybody, before both the .com and the GFC, as well as, 2018-ish, things seemed to be really good. And then you started to see the cracks in the system. And so I am pretty confident that history isn't different this time. We see this irrational exuberance of the stock market, where stocks are up 30-40% in some of these companies, especially tech companies, the Magnificent Seven. Yet earnings are only up about 4-7% if you look at, depending on the stock and the sector that you're in. And so there's this irrational exuberance, in my opinion, that we see at the top of these economies that are really struggling, because nobody wants to believe that it's really not going to continue to be super strong. And then suddenly you start to see the cracks, and they take some time to go through. So that's what makes it really difficult to time it. But I would say that, again, we've talked about the leading indicators that the NBER, National Bureau of Economic Research, uses to date recession. 9 of the 10 have been in recessionary territory. I would argue for close to a year, at least 2 quarters, some of them 3, but they kind of pop in and out, like, oh, we're heading this, manufacturing's in a recession, and then, oh, it's doing a little bit better. And then, different sectors kind of cycle through like these rolling recessions. But the leading economic indicators, Michael, are all pretty negative, but you wouldn't know that by looking at the stock market. And so, there are more corporate bankruptcies this year than there have been for several years, as well as companies starting to lay off. And so even the positive numbers that we see, if you go back and look at the employment numbers and the GDP numbers, they have been negatively revised the following month over the last several quarters in every instance. And so, there are cracks, and I would say that is going to push us into recessionary conditions sooner than later. I would guess, I was wrong on this last year, but I would guess that if the NBER doesn't already date that we are in a recession despite inflation being higher, that it will happen this year. I think we're heading there. I don't think we have much room left, despite what the economy shows. And so, with that being a very real possibility that it's this year, if you continue to have recessionary conditions come, then our probabilities of the Fed not cutting rates this year goes down pretty quickly, because as soon as unemployment goes over 4, even if inflation's high, I think the Fed is probably going to cut rates at least once. But when they do cut, if we do show that we're in recession, and unemployment goes higher, they will cut more rapidly than people think, or they will cut more deeply than people think. So it might not happen. In my estimation, I don't think they're going to cut till July. But if we had true recessionary conditions and layoffs and unemployment tick higher than 4, I think when they do cut, they'll cut more than what most people think. But it's really tough to time it. It just is. If we were able to time it, we all would be making a whole lot more money now. It's just really tough.
Let's remind people of the Fed meetings. And again, there's nothing to say they can't cut intermeeting, but in normal times, they cut during their Fed meeting. So these are the dates. I just pulled it up. This is according to federalreserve.gov. So the FMOC site. So obviously their next meeting is March, just around the corner next week, March 19th to 20th. I think both of us agree, 0 chance of a rate cut at that meeting.
0. Absolutely. They're not cutting rates. Nope.
No chance. The next one will be May 30th and April 1st. I see very little chance, data follow through, that there's a cut at that meeting. Would you agree with that?
Did you mean May 30th, June 1st?
No, April 30th, May 1st.
Oh, April 30th, May. Yeah, I don't see them cutting at that point either, because they need multiple prints to convince them that inflation is coming down, and the last 2 has gone up. So they'd have to see April and May numbers, which they won't have till June, July. So I think there's 0 chance that they cut before June. unless, I always want
Yeah.
to caveat this, if banks start to fail and
Right.
a lot more than that 20% in commercial real estate start to default, and it's actually a little bit more than 20% that have to refinance, plus you add corporate
Yep.
debt. If banks start to fail quickly, which could happen, it always seems like it's just suddenly,
Mm,
then I would change my answer that they will cut pretty soon. But
yeah.
until then, inflation is their enemy number one that they're going after until they can't.
Yeah. So the real debate, I think, comes down to the next two. There is one June 11th and 12th, and then the next one will be July 30th and 31st. If you're looking at what you have today, and again, making a complete wild guess, which of those two do you think is most likely given the data we have today?
July,
Yeah, that's where I'm at as well.
July. I would have thought June and December. And I think we talked about that. In early January, we thought probably June, not March. All those people that wanted rate cuts were like, we're not there yet. But given how strong inflation has reared back
Mhm.
in both the January and February prints, not just core, but PCE, seems to be higher as well. I don't think they have enough data to make those cuts in June. We would have to see a huge,
Yeah.
reversal of inflation really coming down for the print for March, which they'll get in April before they could make those
Yeah.
decisions. So I'm pushing further out to July
Yep.
than June would be my guess based on what we know today.
Yeah, I think we need those extra prints to really feel, because again, we've had two the wrong way.
Right.
I think we do need those extra prints. Now, here's an interesting idea that I've put out there the last couple of weeks is I believe the Fed cuts in July or they wait till December. I personally see 0% chance they make their first cut in September. The meetings in September are September 17th and 18th. That is 3 short weeks roughly from the election. I see Powell having zero appetite to make the first cut in September. He either does July or he waits till post-election, in my opinion. What do you think of that?
Yeah, I heard Daniel DiMartino Booth, who used to work for the Dallas Fed, talk about election year, situations like this, and it actually happened a few times where we've had inflation, during election year cycles, and it's been about a 50-50 chance. But given how political things are right now, Powell has been pretty apolitical. He's not made Trump or Biden very happy, and there are two candidates that are coming up because he is really trying to break the era of easy money
Yeah.
and hope, and he's willing to do what it takes. So I don't think he wants to be accused of being political. So
Yep.
unless you have data that is either significantly inflationary or significantly deflationary and we start to have recession, I don't think he cuts rates right before an election. I think he says, okay, we're going to do what we feel is right in June and July, and then we're going to do nothing in
Nothing.
September,
Just I'm
and
out.
then we'll
Yeah.
take care of it in December. So I agree with you. I think it's unlikely unless something big
Yeah.
happens in the economy between now and then that kind of forces them to say, I don't care if we're called political, we're doing what we believe is
You
best
know,
for the economy.
I actually go. I think he doesn't do anything on Sept. I mean, again, I'm talking the first move, right? If he moves in
Yeah,
July, right, he's on a trend. That's a
yeah,
different scenario. But if they
right.
get past July with nothing, I believe he doesn't do anything September 18th. He's like, screw it, we'll do an emergency cut, on Wednesday after the election or something. He's like, I don't
Yeah,
want to be in part of that. Because again, if you really step back, Biden has done him no favors. He tried to court Liel Braino or whatever the heck her name was to
yeah.
be in that spot. Didn't work out. Trump has talked trash about him. He's got no loyalty to either of these people. And
No,
Powell is playing for legacy. Powell does not want this job. He does not want to be renominated. He is out in like 16 months. So he's like, I'm not playing your guys' game. I am sitting
right.
over here. I'm doing my thing. Oh, by the way,
Yeah.
I'm already rich. So, you're not going to take me out. So I
I
don't see him
think
doing
Powell,
anything.
yeah, I think his legacy wants to be, I was not Arthur Burns who cut rates too quickly and caused a 2 or 3 peak of inflation, because generally inflation does go in waves, and it's usually not one and it comes down and it's gone. It usually hits 2 or 3 waves of inflation before it's done. And so he does not want to be the one that cuts too soon. And as long as he thinks the economy is resilient enough to not collapse or go into a very deep recession, he wants to be the one that can say, we held long, we did not try to pivot, our integrity is important to us. We really aren't going to cut until inflation is meaningfully on its way to 2%. There is no way he's going to do an about face when he has said over and over again, we're not moving on our 2% inflation target. And when you're at above 3 now, instead of, heading down to 2, as long as the economy continues to chug along, despite all of these kind of deflationary, recessionary type of conditions, as long as the economy continues to chug along, the banks don't fail. They work out the commercial real estate stuff. They have the backstops for, trying to convince banks to work with that area that is most likely to tip them into some kind of financial crisis. Until he sees that, he's going to say, I think the new neutral rate is higher than what it was, right? They tried to, before 2018, they started to say, hey, we think we can, the economy can handle a higher neutral rate, and we're going to start raising rates. And they started to do that at the end of 2018. And then January 2019, manufacturing recession, the stock market dropped, I think it was close to 20%, said, we can't handle these higher rates. And they quickly backed off. Powell doesn't want to lose his integrity in that way. He wants to be able to say, let's get away from the zero bound. Zero bound meaning the Fed is giving free money, essentially, because what that does is it continues to create these huge asset bubbles like what we've seen in 2006 and 2000 and 2007, right before the economy crash, and even in 2018. He wants to get away from that zero bound and say, neutral rates have to be higher so that we don't continue to create huge asset bubbles and huge falls in the economy. That, I think, is what he wants to be his legacy. And
he's trying to kill the Fed put. He's trying to kill the Fed.
He's trying to kill the Fed. And no Fed Reserve president has been able to do that historically. They just haven't. Yep. They haven't had the will to do it, in my estimation, because they want to be able to say, we're producing enough GDP in the economy to be higher than inflation so that we could positively grow. And if they start to see that, that GDP is at risk, they tend to cut rates. And so I would be shocked, Michael. I've learned that nothing is beyond the realm of possibility, and everything that I thought that could never happen, it has in the last couple of years. And so, nothing is completely off the table. But to me, barring a banking system, financial system collapse, probably stoked by commercial real estate with rates being too long and corporate debt being too long. Barring that happening, I think there's no way on God's green earth that Powell cuts rates until inflation has really started to come down at least for 2 quarters. That would be my guess. Which
I think Powell's great fear is he cuts rates. Like he cuts rates. He tinkers. He cuts a quarter.
Yeah.
Animal spirits take over. Yeah. Animal spirits take over. The market thinks more is coming, blah, blah, blah. And he has to reverse that cut. That is his greatest. That's why I've always believed he's going to go 1 month or one meeting longer than anybody else would. I've always believed he's going to go one extra meeting. That's why I think there's a non-zero chance that the first rate cut is December, post-election.
Yeah, I agree with you there. It's definitely non-zero. And the further we go, the more that seems like it's not out of the realm of possibility. It's really hard to time it. But, again, the question is, how bad into a recession does it have to get before Powell says, this two-headed monster that we're
Mhm.
fighting, which is, high inflation and then the economic system trying to keep growth and keep employment low, get us out of a recession. Right now, inflation is the greater threat because the economy is just chugged along. Once you get to where, you have big layoffs, you have corporate bankruptcies, you have banks start to fail, you have unemployment start to tick up, then he switches that, then and only then does he switch gears and say, the bigger risk right now, even though inflation is still there, is saving the financial system, the banking system, and not going into a depression and or severe stagflation. Because again, we talked about last week, go back and listen to that video if you haven't, how stagflation is really much worse than either high inflation
Yep.
or a deep recession. So I don't think he switches gears unless the economy finally tips over and it goes down and it goes down hard. No, no chance.
Yeah.
And is that going to happen in the next 3 months? I would have thought it would have already happened, and it didn't.
Mhm.
So I can't figure, but I do think this is just the thought off the top of my head. I don't know if I'm right or wrong, but we're heading into spring break. We're heading
Mhm.
into when most of the consumers who are spending money still have kids or grandkids, they're traveling. They're going to travel in March and April, and they're going to go on vacations. And I think they're going to spend more money in March and April. And so they're going to just put it on their credit cards like American consumers do. And I think that that's going to be a positive print and keep the economy chugging along a little bit. Then you have April, May, we'll see what happens. But in the summer, it's kind of like Christmas, right? We all said, consumers rock, there's too much debt, but they'll probably still spend a bunch of money on Black Friday and Christmas. And guess what they did? Because consumers that have been in kind of this limbo of up and down economy, for 3 years, let's say at this point, three going into 4 years, they want to travel with their families. And I think
Mhm.
that summer people are going to spend money. They're going to travel. Gas prices, um, gas may go up, who knows? But I just think going into spring and summer and good weather, typically consumers start to spend more money. So that could keep GDP going a little bit. It could kind of extend this inflation and doesn't mean the economy is necessarily getting better, but I think it could push into summer before you start seeing any real pain become evident enough that Powell might in July say, okay, we got to cut.
Yeah. Well, let's play the pain out because I think you're right. I think you nailed where the pain will show up. Again, we're assuming no rate cuts in 2024 or the first one perhaps in December. I think you're right. I think the commercial real estate market takes it on the chin. I think one of the things we have seen as you kind of go through the stages of grief, there are more and more people thinking that commercial real estate owners and banks are at or near the final stage of acceptance. And
Yeah,
deal flow, deal volume is down 70%. That
absolutely.
eventually is going to pick up, and we're gonna actually start trading, which means we'll have true price discovery.
Right.
I suspect, my opinion only, there's a lot of people in stressful situations, owners and banks, who frankly are praying to Lord or God Powell to cut rates. I don't know that even a quarter of a point saves them, but they're certainly acting like it might. And if we get through the summer with no rate cuts, I think at that point, there's some kind of the straw that broke the camel's back and we have true unwinding and recognition. And then the other thing that I think happens, so we have trades, right? We have price discovery. The other thing, again, I keep going back and doing the math, right? We're talking about 900 billion, let's call it $1 trillion in commercial lending coming due. The lenders, in at least most cases, because of the LTVs, their haircuts won't be catastrophic. It's the equity that goes to zero.
Yes.
I don't think a lot of like a lot of people are saying commercial banks are going to, and there'll be some like, hey, New York Community Bank, you have 53% of your portfolio in subsidized housing, you're screwed, right? Bad job of risk management. But when you look at all the other banks, they're really diverse. They're not going to likely be taken out by one or two buildings having a 10% haircut, but the
Sure.
equity goes to zero.
Right.
What do you think of all that?
Yeah, I think it definitely depends on the bank. When you look at the breadth of the issue, it's close to $1 trillion. Again, I've read anywhere from 800 billion to 1.2 trillion, depending on the data source, because the data isn't all readily available. So some of this is guesses and surveys by banks, et cetera. But let's just say it's $1 trillion. It's
Sure.
about a quarter of the outstanding 5 trillion-ish commercial real estate debt that we have in the system that's due to refinance in the next 5 years. Okay,
Sure.
so
Sure.
if you spread that over 5 years, assuming that it's evenly spread, which isn't really realistic, but that's kind of the best people can do to kind of say, based on what we think we know, most of the debt that was taken out at low interest rates are termed out over max 5 years. A lot of 2-year bridge debt, sometimes three, sometimes there's a 3-year with a 1-year extensions. So, you've got these loans that, some of them are 2 or 3 years interest only. And then, they start paying principal and interest, and then they have to come due. So let's just say you've got $1 trillion, to be conservative,
Mhm.
coming due. The question is, and most of that is at regional banks. It's not the
Oh, yeah.
really large banks,
Well,
because
let me ask you one question, because again, I don't you and I understand this, but this is for the audience. If there's $1 trillion in debt, that probably means the assets at the point of purchase was probably like 1.5 trillion. So again, the reason I bring that up, because there's 500 million that can be wiped out first before the banks are even touched.
yes, absolutely, absolutely. It's a lot of money for private investors who, the equity is wiped off the table. And if you look at that 20%, that $1 trillion, about 20 of that 20%, apartment values, multifamily, are down about 20% in
Correct.
value.
Yes,
So,
they are.
you know, commercial office space, big towers, commercial office, primarily retail office, it's about 40% loss in value. Okay.
Yep.
So the question is, in the portfolio of $1 trillion and how it's spread out across these regional banks, which one were more heavily in office
Correct.
versus multifamily? I
Mhm.
would argue that, generally speaking, those that have office loans are the ones that are at significant risk, where the values, if
No
they're
doubt.
if the stats are right, are down 40%. A lot of them financed at 75 to 80% LTV. So
Correct.
your equity's completely gone, but banks are going to take a hit of,
Sure.
let's say it was 75% LTV and you're down 40%. They're going to take about a 15% hit on
Mhm.
that asset if they have to take it back. But
Correct.
not only are they taking that hit in LTV, they've now got a product that is more difficult for them to sell because of
Sure.
office vacancies and this whole, remote work situation that's making
Yeah.
offices less needed than they were before. But
I'm
also, if they're older properties,
Yeah.
those that are staying fuller in office are these new Class A office buildings. So the banks are going to suffer as well. The question is, how many banks are more heavy in office than multifamily? Because multifamily,
Yeah.
by and large, again, it's
Yeah.
very, maybe we take this as a next question, is very bifurcated between
Sure.
large market, small market, Class A, Class B, Class C, and they're very, very different animals.
Yeah. So I think office is actually a pretty easy fix, because again, if you kind of go down to where the real write-offs are gonna be, I see these institutions pulling out the old tricks, extend and pretend. And again, office buildings, generally speaking, aren't where LPs got involved. These are usually insurance companies and pension funds and university endowments, right? Because again, for the longest time, office was class A, triple A, can't get any worse, safest investment. Now let's go to multifamily. You're absolutely right. I think the stats are 20%. Multifamily is down 20%. If that is true, my opinion is banks don't take a haircut.
They don't take much. They don't take much. Again, when we kind of talk about the differences in multifamily, those that a lot of multifamily, the strong assets are actually held by Fannie and Freddie loans, federally
Sure.
backed mortgages.
Mhm.
And those generally are products that are already stabilized when they're purchased. So
Yep.
they're more of a buy and hold type of asset. Now, yes, we use them for some value add, but they have to be 90% occupied and stabilized
Correct.
when you buy them in order to get that Fannie Freddie debt. And so you're keeping your products fairly stable. And by the way, Fannie and Freddie, they require quarterly reports, quarterly rent rolls, financials. So they're making sure that you're not like totally unstabilizing and renting 50%, renovating 50% of the property at any one time, or you could lose the loan and be in default. So they're kind of these hybrid value adds. There was a lot of those done, and those are least at risk. Where you really have the risk, Michael, is those properties that were bought that were not stable to begin with. They were
Mhm. Of
Class C, Class D properties.
course.
They were not managed well. They had, 20, 30, 40% vacancy, and therefore they couldn't get Fannie and Freddie loans. So some banks did take on these
Mhm. Of
mortgages because they're like,
course.
okay, you have a history of being value add investors. We understand we're going to give you interest only payments so that you can empty these places of the poor
Mhm.
quality, non-paying tenants. You can renovate them all. And we know that in 2 to 3 years, you're going to have an asset worth a lot of money. There are some banks that did those, but by and large, those were done by bridge
Yep.
lenders that are
Correct.
non-bank lenders. So it's the bridge lenders that are really going to be in trouble if the
Agreed.
operator wasn't able to finish their value add or get close to it planned by the time that they bought them. But these banks, if they did very many loans that were kind of these huge value adds, unstabilized properties, they probably lent them on a lower LTV, to your point. They're not giving them 75 or
No,
80%. They probably
60,
gave them 60,
65.
65%. If those
Exactly.
operators were able to implement at least, half or 2/3 of their value add, then they've increased the value significantly based upon the increase in income that they generated. And that in some ways offsets the rise in cap rates that brings values down. So the incomes bring values up, the cap rates bring values down, to where I think that a lot of these loans, from what I've seen, actually did get through some of their value add period in the last couple of years. And so that increase in value offset by the decrease, I still think puts them to where the property is at least worth what the debt was on that property, if not more. The question is not that the properties have lost so much value that the banks definitely go under. It's, can the banks, from a regulatory perspective and their own will and their own financial situations, do they have the ability or the wherewithal to extend loans to
Yeah.
investors who are paying on time, even if their debt coverage ratio no longer makes sense? Like, in other words, in order for me to refinance a loan, okay, when rates go higher, I have to show the bank that my value is more than the loan amount. Okay, that's
Sure.
one issue. That's the LTV that we were talking about. But the second thing I have to say is, does the income that I bring in after all expenses, my net operating income, is that higher than the loan payment that I'm going to have to pay by a cushion? And generally speaking, loans require your net operating income to cover the debt plus about 25 to 35% more cash to give you operating, reserves above and beyond that loan. The loan covenants, when a lender issues a loan, say your LTV must remain here as at least as high as when you bought, the property and got the loan, and your debt coverage ratio has to be maintained.
Mhm.
The problem that we're seeing is that regulatorily, banks cannot necessarily allow them to keep going when they know that they're not going to
Yeah.
barely break even and cover the debt. And so
This is
some
why I
banks will have to take it over, regardless of if they would be willing to otherwise extend, because of just banking regulations.
yeah, no, I this is exactly what I see coming out. And again, the bank's not hurt. The bank has regulations. The bank has to take it back. The bank will sell it to the next operator. The bank will get another loan, but the new buyer will bring in 35% or 40%, taking the
Yeah,
loan value way down. These are going to be some of the strongest loans written. The
they
unfortunate
can
part is
be, but it's
the
all
current
about
operator
timing.
gets hurt. Sure, of course.
Right. Yeah, the operator, the equity, they're wiped out. They just are. If a bank takes it back, it's all about timing and how much of the book has to be taken back and those assets of the bank written down
Right.
at the same time. So just like we saw, Signature Bank,
Yep.
SVP, we saw these banks start to collapse because of bonds having to be
Yep.
moved from
Move to
hold to
mark to
maturity
market.
and
Yep.
mark down, mark to market. The timing of when banks take things back. If they take an asset back, they have to write a loan back. They have to
Yeah.
write down their assets. And so assets and what's written down has an impact on reserves that the bank must hold as well.
Of course.
And
Yep.
it can make certain banks who are really heavy in those assets that might have to be marked. I'm just going to make up
Yeah.
a scenario. Let's say I'm
Yep.
a regional bank and I'm in San Francisco, right?
Uh-huh.
And San Francisco has been crime ridden. People
Mhm.
are leaving. Nobody wants to work downtown. Let's say this regional bank that focused on office in San Francisco and retail has,
Done.
50 loans that are hundreds of millions of dollars, and all of a sudden everybody's fleeing San Francisco and vacancies are crazy. If
Yeah.
that bank and these big office, even funds and big REITs are handing over the keys because they can't get
Yeah.
refinanced,
Blackstone's done
that
it. Yep.
type of bank is very subject to failing because they've got to
Yeah.
write down a lot of their
It's
book.
Silicon Valley Bank all over again, right? You get a bank run. But
Absolutely.
those are going to be few and far between, in my opinion, right? New
Yeah.
York Community Bank is currently the one, under the microscope because it's so over-indexed to affordable housing or rent control or whatever it is in New York.
Right.
You're in
Right.
trouble. Sorry. You're in trouble. You
Yeah.
just are. But again, I want to go back to the banks that may be forced to take over multifamily because of banking regulations, right?
Sure.
You do $1 trillion in lending. You do 650 $1 trillion purchase, 650 billion loan, right? 35% down.
Yeah.
Now, because of all of this nonsense and cap rates, and all of a sudden, these buildings are now worth 750. You have 650 of debt. Where forget the mortgage pay down and stuff. Your rules say that you can't. That's not enough margin. So you first you go back to the current owner and say you got to sell the building, or do a cash in refi. Those are your two options.
Right.
You have 6 months to execute that. Just making stuff up. At some point, let's just assume that doesn't happen. They take it over. Again, the bank now takes it over at 650, right? Because it can't be sold at 750 for whatever reason. The bank will eventually sell it, but this is where the magic happens. That 650 building will be sold again, let's just say for 650, but the next new loan will be like at 480. So those loans at 480 on an asset that used to be worth $1 trillion, this is exactly what happened in residential housing. The bank
Yeah.
stopped lending in 2010 and prices cratered. Those were the safest loans to write. You were buying houses for less than land value.
Yeah.
So it'll be
Yeah,
interesting to watch
the
this
banks
unfold.
can make out. It's really difficult to say just based on the stats. Now, I do think that there is probably more risk, even though that is a possibility for the banks. Banks are also saying we're in a more inflationary world than we used to be. And if rates stay higher for longer and inflation stays higher, even if we have a recession and the Fed gets us out of it and cuts rates low, inflation's going to continue to rear its ugly head, and we're probably going to be a higher inflationary environment in the future. And banks are thinking about this because if that happens, treasuries stay higher, cap rates go higher, properties could still lose more value than they already have. Not very many people are talking about that, but it's
Well, it could.
possible. And so, banks don't want to hold assets for a real long time before they sell them.
I agree.
So, and there are big REITs that are already, gearing up with a bunch of cash to try to take banks' properties off the balance sheet for them.
Yeah,
Pay
this is
cash, do
exactly.
whatever.
Yeah,
So
this is the
it's
key.
happening. But that doesn't mean, I think my only caveat to this is it doesn't mean that there is no risk of a banking crisis. There are
Oh, no.
still
Of
banks, a
course.
number of banks that are very highly commercial real estate leveraged, commercial real estate leverage on their books that are their assets that could be written down.
Oh,
But
yeah.
at the same time, they've still got the bond issue where
Mhm.
they still are holding
Yeah, hold to
bonds and
maturity. Yeah.
treasuries hold to maturity that they haven't written off yet. So
Yeah.
if they get in a liquidity crunch,
Yeah.
and they have to write down, commercial real estate, and they have to write down, more of these longer term bonds because the Fed, let's say going back to our first hypothetical, the Fed
Mhm.
does keep rates a lot longer,
Yeah.
higher a lot longer, you could have more banks start to crumble. So I still think that there is some risk of that.
Oh,
But I think, to your point, the risk is probably somewhat overblown given the fact that if you're a well-rounded, diversified bank and you were lending not just to commercial, but maybe you lent on, land and
mhm.
multifamily and self-storage and mobile home parks, and you have a pretty well-diversified portfolio, then one or two loans going bad is not going to put those banks into a crisis. But I think
Yeah.
that there's still enough risk that Powell and Yellen have said it's a real risk that we're
Oh, for
watching
sure.
and a little nervous about. So, how many banks start to fail is really the question, and it's hard to know that. I do believe we hinted on this in a previous discussion that the Fed and the Treasury are not going to let there be a mass banking
No.
crisis like there was in the 80s. And,
Agreed.
post the 70s inflation, cap rates going up, values falling. We saw over 1,000 banks fail. And those bank failures didn't just happen in 1 or 2 years. They were
Oh,
stretched over about a 15-year period from like 1980 to
yeah.
1993, I think. So let's say
Yeah.
12 or 13 years before the end of it was done. I think that they come in with more bank rescue programs to keep the financial system from just completely
Yeah.
collapsing. But these are the kind of things that are cracks in the system that really make it difficult to say where are things going,
Mhm.
because number one, the numbers are not all well known. Number two, we don't know what the Fed's going to do. We don't know if something else could happen that could stress the banks and stress commercial real estate. There's definitely risk, to the banking system and to commercial real estate overall, and that tends to trickle down and have many other impacts, such as layoffs of property managers and property management companies and construction workers who are doing these value add things. So, I think that the pain in commercial real estate has a lot of things that it could trickle down and impact in the economy. So it's not good for the economy overall. We talk about the pain to the investor, the pain to the equity, the LPs that are wiped out. But I think that it's just more stress on the financial system overall, on employment
Mhm.
numbers, on GDP, et cetera. Because real estate really is a large percentage of GDP,
Oh,
has
sure.
always been, and will continue to be.
Yeah. I really, when I think about the commercial umbrella, right, or the whatever, the envelope, I, I really go back to we have to have price discovery, right? We're down
Yeah,
70% volumes. We're not going to stay here forever, right? One of the things about commercial real estate, as you know, is given the debt structure in these average 5-year or 3-year terms, these things turn over a lot more than residential housing.
yeah,
And I do think the pain is overblown. I think the
yeah,
equity positions, just again, I lived through this as you did, the housing crisis, where the average loan was like 98.5% when they put it all together. Some were 103%, which is just
right,
bananas. You don't have that in commercial.
right.
We have some very acute pains, office, San Francisco, affordable housing or rent control in New York. There are some
Mhm.
spots that are going to undoubtedly take 50, 60% haircuts,
Right,
but
right.
that's not the country and not the entire asset class of commercial.
Absolutely. Absolutely. And one of the things that's nice about multifamily, this is why I don't think the risk in multifamily is near the risk that there is in office,
Mhm.
personally. And I operate multifamily. So I'm on the front lines of seeing what, our pains are, and the good, the bad, and the ugly. We're still looking at opportunities, but many people thought the opportunities would have been huge by now. Prices, we would have had just tons of defaults. And that really didn't happen. And one of the reasons is because most loans that are done through banks, again, we're talking about the banking system, they're at least a 10-year term. You might have 5 years of a fixed interest rate, but you've got at least a 10-year term loan. They
Mhm.
might amortize it over 20 or 30, depending on your bank. But 10 to 20 years, 10 to 25 years is really what most banks lend on. And so again, as long as you're in a stabilized property and you're making your payment, those banks are less likely to really default, which has kept a lot of sellers from having to sell. Most of what I see that's hitting the market to sell, it's almost all bridge loans, Michael,
Yeah.
or it's
That's the problem.
variable
Yes.
loans that have a rate cap. And the rate cap, and I know because I have a property, okay, just as an example of how bad this can be. Rate cap for a 3-year rate cap purchase at $36,000 for 3 years. The bank says, oh, we need to renew your rate cap, and you have to renew for 3 years because your initial rate cap was 3 years. Guess what the price of that new rate cap is per year? $1 million.
Per
How
year.
many of you per year?
$3
Well, to
million
buy the
bucks.
3-year rate cap, $1
Oh,
million
so okay.
to buy the
So
3-year rate cap.
so 333 a year. So 10x.
So I think that when I have to renew my rate cap, it'll be another 36,000. Rate cap insurance didn't exist before this period. So no one had a history to say, oh, by the way, underwrite that your 36,000 that you're holding in reserves that you think you might need in 3 years to extend your rate cap, it's going to go to $1 million. Nobody thinks about that. So
No.
it's those properties that have $1 million hit
Yeah.
that they can't, they need
Yeah.
capital calls from investors to handle the million. Their monthly mortgage payment now escrows that extra, $80,000, $90,000 per month. So you can't
A
pay your
month.
investors
A
a month,
month.
right?
Yeah.
So these are the properties that are hitting the markets to buy. They're distressed because they have bridge debt or they have a good longer term loan, but they have rate cap insurance.
Yeah. The
And rate cap
financing.
insurance was
It's
starting to come down as inflation fell and everybody
Mhm.
bet the Fed was going to cut rates. Well, all this higher for longer makes that premium for rate cap insurance much longer. So
this is why I think we're going to see more volume in trades, because again, that was a good building, but the structure makes it unattainable, and sometimes you got to get out and
right,
get it to the
right.
next. This is
But
coming, I
here's
think.
the interesting thing is a lot of syndicators, okay, are raising cash from investors
Yeah.
who are afraid to buy multifamily or commercial real estate because they're
Sure.
hearing it's like
Oh,
taking a tank in
it's a lot
values. And
harder now, I'm sure.
a lot harder to raise money from investors who by and large watch the news and they're afraid, right? And so they don't want to invest. So you have only really big REITs that want to come in and buy these assets. But here's the challenge. Another thing that I don't hear anybody talking about, right, is that big funds only want to buy Class A multifamily
Yeah.
in Class A markets, brand
Yeah.
new builds, 3 to 5 years old max,
Yep.
in really strong markets where they think that even if we have a recession and unemployment goes up, it's not going to hit that area very hard. So, for example, Houston, Texas, Atlanta, Georgia, Phoenix, Arizona, generally speaking, have good job markets, have strong GDP, Raleigh, North Carolina. The funds want to come in and buy the Class A stuff that's taken a big hit in value because of interest rates only. They don't want to come in and buy my Class C multifamily value add deal that a syndicator did that's distressed, because they're not in the business of buying and flipping and value adding apartments. They're in the business of buying good, stable properties and holding them for their investors to make a return, right? So even though you have some distressed, I would argue, this is just from boots on the ground, I don't know if this is statistic nationwide or not, but I would argue, based on someone who's in the market, who sees what comes available for sale, that most of the stuff that's distressed that's coming up is not Class A stuff in Class A primary markets, and therefore the big REITs are not interested in buying them. They're waiting for a syndicator who's got enough experience and can raise enough money from investors that they can afford to get very low LTV loans and raise a whole bunch of cash. And the reality is what investors need to sell them for versus what investors need to buy them for, there's still a big disconnect. And that's why, Michael, a lot of these operators that can't sell them hand
Exactly.
over the keys.
Exactly right.
That's just the reality.
That's where we are. That's why the pain will be there. It'll be interesting. Again, we're not calling for no rate cuts. This is just theory. Anna, where can people find you?
Right. You can find me every week on your show on social media, Anna Kelly, REM Mom, and for real estate investor consulting and coaching and deal review. You can find me on my website at AnnaKellyInvesting.com.
Thank you so much.